Welcome to everyone tuning in, and thank you for joining us today. My name is Matt Sampson, and I'm a senior investment advisor and wealth strategist here at Arnerich Massena, a Portland-based investment advisory firm, bringing our unique and disciplined process to high net worth families, nonprofit endowments, and foundations. Today, I'm here with my colleague, Glen Goland, who spent his previous life as an estate planning attorney, to talk about how rising interest rates are impacting one of the most commonly used legal tools in the estate planning space, the Grantor-Retained Annuity Trust. Glen, thank you so much for being here today.
Thanks, Matt. I'm glad to be here.
So if we start out just with the basics of Grantor-Retained Annuity Trusts, you and I have worked with a handful of clients on efficiently gifting assets to members of the next generation. And one of the tools we've looked at is the Grantor-Retained Annuity Trust, or the GRAT. Can you talk for a minute about GRATs and how they are utilized?
Sure, I'd be happy to, Matt. The GRAT is just one of the tools available to an estate planning attorney to help gift assets to the next generation in a tax-efficient manner. So clients have probably heard of CRUTs and CRATs and CUPERTs, and the GRAT is just one more of those vehicles that attorneys have available to them. The GRAT is commonly referred to as an estate freezing technique. So what you're trying to do is give away the appreciation on an asset based on its dollar value today. And so when I set up a GRAT, what happens is essentially, if I am the one that sets it up, I am the grantor, and I am retaining an annuity from that trust, hence the name. What that means is that if I set up a GRAT today, I am essentially setting up a payment stream that is guaranteed to come back to me over a period of years, depending on how long the GRAT is. And we determine that payment period or that payment amount coming back to me by looking to the IRS's rate table under Code Section 7520. And so practitioners will refer to this as the 7520 rate. It is the interest rate that GRATs are built upon. And that interest rate has been changing as the Federal Reserve has adjusted interest rates over the last year. And so for anybody that's looking at a charitable remainder trust or a GRAT or a qualified personal residence trust, the math on all of these things has changed over the last year as the rates have risen. Some of those tools look better now, some of them look a bit worse. One of the things that I think it's important to remember about GRATs is that they're generally set up and established with marketable securities. And the reason that it's done that way is that the securities don't actually have to be sold by the trust. So everything can be done via in-kind exchanges. And so I can transfer assets into a GRAT, and when it's time for me to take that income or that annuity payment, I just transfer the assets back. There's not a realization of tax at that. So it's a really efficient way to generate that income stream. What I'm really trying to do is put assets into that trust that are going to appreciate above that IRS rate. Right? Because any appreciation above that IRS rate is the amount that's going to pass to my beneficiaries without using my estate tax exemption. So the most eloquent way that folks will set these up, Matt, is they'll do something called a zeroed out GRAT, where they'll sit down with an accountant and or an attorney. They'll look at the current IRS rate and they will put together a GRAT for a period of years at that rate that is designed so that at the end of the GRAT, all of the annuity payments and all of the value of the GRAT has been distributed. So whatever that remainder is passes to the beneficiaries. And if you can zero it out properly, you can do so without using any of your estate tax exclusions. So you got to involve an accountant and an attorney to do some of the tricky math, but that's the basic overview.
Thanks for that information, Glen. Can you talk our listeners through the examples of when you have seen GRATs work well and when they have not worked well?
Yeah, absolutely. The neat thing about GRATs is that you can do them in short time frames. And so you can set up a GRAT as short as 2 years. Commonly, the longest you'll see is about 10. So the most effective strategies I've seen used are when we have executives at publicly traded companies that own a lot of stock in the company. So say Nike or Intel, that sort of thing. We've seen clients set up 2-year rolling GRATs where they put their Nike shares into the GRAT at, say, the 75/20 rate is 2 or 3%. And after a couple of years, those shares have appreciated 10 or 12%. All of that excess growth is just rolled over into the beneficiaries, while the GRAT owner just takes their GRAT payments and starts a new GRAT each time the payments come out. And so For executives at publicly traded companies whose stock is appreciating is a super eloquent way to pass all of that appreciation out of their estate without impacting their estate tax math. Where they don't work as well are either when the assets don't perform as well as that 75-20 rate, right? And so if I set up a GRAT and the 75-20 rate is 5%, but I only earn 4%, well, there's no remainder to pass to my beneficiary. So it's essentially as if I had never set the GRAT up in the beginning. The other thing where GRATs can go sideways, Matt, is if I pass away during the term of the GRAT, it's essentially canceled for tax purposes, and it's looked at as if I never set that up. And so the ideal situation is when we've got shorter time periods with highly appreciating stock. The less ideal one is when somebody's closer to the end of their life and there's a higher chance that they won't outlive the GRAT period, or if they've got investments that aren't going to meet that 75-20 rate.
Yeah, thanks for that example, Glenn. So, you got me thinking, how exactly do rising interest rates impact GRAT owners?
Well, I think the main way is the one that we just outlined, right? Is that if the 75-20 rate reaches a height so large that my investments don't reach that number, then the GRAT's not going to do anything for me. The other time that these things can be impacted by rising rates is what we saw last year in 2022, where rising interest rates led to dramatic movements in the stock and the bond markets. And so for most folks that had public securities inside of a GRAT last year, the rising rates hurt them because their values dropped. And if their values drop, they're unlikely to ever reach that hurdle of that annuity payment determined by the 75-20 rate. So it's less likely there's going to be anything left at the end of that to pass on to beneficiaries. So where we see the biggest impacts in that, one is what we saw last year, where rising rates impacted the value of the underlying assets, making it less likely the GRAT was going to be completed. And the other way we see that is if you've got a series of rolling GRATs and you see rates rising, then those subsequent GRATs become less and less likely to be affected because the rates are higher. So what you'd see with practitioners is that there are some tools like charitable remainder trusts and charitable annuity trusts where rising rates actually make them more beneficial for the grantor. On the flip side, some of the commonly used tools like a Grantor-Retained Annuity trust become less attractive with these rising rates. So what we would tell folks is they really ought to be just checking with their accountants and their attorneys to make sure that they have a sense of what the math is with their situation to make sure that they're planning appropriately.
Well, thank you, Glenn, for sharing your insights on grants and how their effectiveness is changing with rising interest rates. And based on your answer, it sounds like the best bet is to reach out to your financial advisor as well as your legal team to see if this sort of structure makes sense for you and your family. Do you have any final thoughts to share on the topic before we wrap up here today?
Well, first of all, talk to your expert, because I just realized in my last answer that I misspoke. So charitable remainder trust and qualified personal residence trust do really well in rising rate environments. The annuity trusts get a little trickier. So again, always talk to the expert, right? And we're happy to be part of that conversation for any and all of our clients. The other thing to think about is that right now, Congress looks messier than it has at any point during my lifetime. And so as a result, it's becoming more and more likely that in 2026, the 2017 Tax Cut and Jobs Act provisions will sunset. And so if you recall, when that legislation was passed, there was a lot of hubbub at the time that the corporate benefits went on indefinitely, but the benefits for individuals stopped after 2025. And the folks in government at the time promised us that, don't worry, we'll kick that can down the road and we'll deal with it. Well, it's now looking like the more contentious Congress that we have, the less likely it is that we'll see some sort of extension of those tax levels. And so for the families that we work with today, they can pass $23, $24 million to their heirs without having any federal estate tax, provided they apply their exemption properly. Well, we think in 3 years, that number is going to go down to 10 or 12 million per family. And so for families that have assets in that size, they should really be looking at these next 3 years as an opportunity to make this sort of gift. And as part of that gift giving process, they're going to see that rising and falling interest rates are going to play an important factor in which tools are most effective for them.
Thanks, Glenn. A lot of great stuff to consider here. Just as a reminder, you can find Glenn and myself at our office in Northeast Portland, and you can always visit our website at arnerichmassena.com, where you'll find details about our team and a blog where we post relevant articles surrounding financial planning topics. Thank you, Glenn, for being here today, and thank you to our audience for joining us.
Thank you for listening to Arnerich Massena's podcast. Please see the podcast description for important copyright and disclaimer information.